What's up, everybody? Welcome back to another episode. Joey here. Cannot wait to dive on in to taxes. So we're going to be talking about taxes today. Are they more simple than we think? Are they more complicated than we think? What does it look like to actually set yourself up well? What's the system that Christy and I use to manage our money and prep for taxes? I want to break down a bunch of that stuff today in today's episode. Hopefully it's going to be a quick one. This is a very complicated topic, not because it's super complicated, but because we're just very uneducated in it. You know, the average American is very uneducated. The average creative, photographer, filmmaker, social media manager, content creator, we are all uneducated in taxes and small business taxes. And so it's complicated from that perspective, but I hope today that I can just really bring some clarity to what taxes are, how they affect you as a small business owner, and what you can be doing to mitigate your tax liability, AKA what you can be doing to pay less in taxes, or just to understand what taxes you're paying and how to do it properly, okay? So I'm really excited about this episode. I love talking about finance. I love talking about the things running a business that a lot of people often run from, and taxes would definitely be on that list, right? You might have even clicked on this episode because you were like, I know I should listen to that, but I don't want to. And I'm going to give Joey like 30 seconds to prove to me why this episode is going to be worth listening to. So here's what I want to say. Listen to the whole thing. Give me like 12 to 15 minutes. And at the end of this episode, I guarantee you will feel much more confident in understanding taxes as a small business owner. And ideally, it's going to take a lot of the fear or scariness, is that a word? Scariness, the fear or the scare out of taxes as a self-employed creative, okay? So I have met people right off the bat that have said, I don't want to be self-employed because taxes sound crazy. I don't want to be self-employed because it's too complicated. I want to be an employee, have my employer do it all for me. And one of the reasons why I love being self-employed is because I actually get to do it all. And this is what's really interesting about being an employee versus being someone who is a self-employed creative is you have the ability to work your finances in a certain way that can be in your favor or in the government's favor. Okay. Now this is a benefit that self-employed individuals get. People who are employees of corporations, like most Americans, most Canadians, most Aussies, most Europeans, wherever you are listening to this episode, employees don't have the same creativity and flexibility that it comes with being self-employed around the idea of taxes and around the idea of finances, okay? So there's a couple of things I want to cover in this episode that are going to kind of spin off of that. But one of the biggest things that I want to encourage you with right off the bat is that being self-employed is actually an awesome thing because the tax code is built for small business owners. The tax code is built for small business owners. I'm going to say it one more time. The tax code is built for small business owners. It's not built for employees. It does not lean in the favor of employees. It leans in the favor of people who own businesses. And so it's time you learn how to actually use your business to make sure that you are operating in a way that is going to make you happy come tax season. I'm going to break down what that can look like in this episode. So glad you're here. By the way, if you're new here, my name is Joey. Started Creative Rise with my wife back in 2019. And for 6 years, we've been helping creatives just like you and like us. We are photographers, filmmakers, and brand strategists, designers, helping people just like us learn business so you can actually get paid to do what you love, because getting paid to do what you love all comes down to how well you understand business strategy. So enough about me. Let's talk taxes. So right off the bat, though, I want to shout out a quick win from our community this week before we jump fully into the taxes. This is from Jason. Jason is from the northeast of the U.S. Shout out to Jason. Jason's an awesome dude. He said, hey, just wanted to update you guys. Everybody that was on the November call last week, it was a call for a bunch of grads that have been through the mastermind. I closed the deal with the 8-figure-a-year tech company founder who wants to start developing their personal brand and go all in on Instagram. Super pumped on closing this custom monthly package this weekend. Really excited to hear what you guys have to say about it. Not sure if anyone's done something like this, but I'd love to hear from you. 20 short form videos broken down into 2 shoots per month. So 20 short form videos a month broken down into 2 shoots per month. Those are all going to be about 3 to 4 hours each. So about 6 to 8 hours of shooting per month. 1 or 2 strategy calls per month to help them implement the content and plan and script the content for the next month. And I'm doing this all for $46.50 per month. Guys, that's over $50,000 a year just from one client. So shout out to you, Jason. Super proud of you, bro. I know you worked really hard for this deal. Let's jump on into taxes. So a couple things I want to cover right off the bat, guys. Earlier I said, and this is a huge claim, but it's very, very true. Okay, it's super important. The tax code is built for you as a small business owner. It is not built for employees. It is not built for people that are employed. The tax code leans in the favor of people that are small business owners. So it's about time you took advantage of that, understand how it works, and this episode is going to give you some understanding around that. So most creatives don't actually have a tax problem. They have an understanding of taxes problem, okay? And so this is a really, really big difference because a lot of creators feel a ton of fear. They feel a ton of scarcity. Sorry, my iPad's freaking out. A lot of fear. They feel a ton of scarcity around the idea of taxes because it feels like a world that is fully gray that they do not understand. And it wells up something in them where they're like, I don't know if I'm just going to hit with a random bill at the end of the year. I don't know if I'm even going to have the money. I don't know if I'm overpaying, if I'm underpaying. Creators think taxes are scary. Creators think taxes are too much. I agree with that, depending on where you live. Where we live in California, definitely too much. Where I'm from in Canada, definitely too much. Creators think that they are getting robbed by the government. You're working so hard, so hard to make a deal, get a new client as a photographer, filmmaker, social media manager, content creator, and then the government swoops on in and decides it wants to take a bunch of your money. Now, here's the good thing. I already told you the tax code is built for small business owners. It's not built for employees. So when you get a deal, when you grow your business, when your business earns revenue as a self-employed business owner, self-employed creative, you get the opportunity to do something with that money that can really reduce your tax liability, aka how much you owe in taxes. So a couple things that I want to talk about. This is the first one. This is the most important thing you have to understand about taxes. This is what a lot of people don't understand. You do not get taxed on the money you make. You get taxed on the money you keep. Okay? So it's not what you make. It's not the revenue that you have to pay tax on. It's the money that you keep and you put aside to the side. That's called profit. So taxes don't apply to revenue. Taxes only apply to profit. So one of the first things that a lot of creatives need to figure out is, what is your profit? What was revenue? What was profit? I ask this all the time to people. I say, hey, what's your business do last year? A lot of people can tell me what their revenue was, but they have no idea what the profit was. If you don't know the margins, the percentages in which you are retaining profit, you're keeping profit as a photographer, filmmaker, social media manager, meaning after you make the money and then after you subtract your expenses, that is your profit. If you don't know where that lies, well, then of course you're feeling stressed out about taxes because you don't know how much you're probably going to get taxed, okay? So that's number one. The first thing you need to realize is that taxes are only on what you keep, profit, not on what you make, which is revenue. And so this gives us a really cool opportunity as self-employed creatives. If you're an employee of a corporation, you get taxed on the money that you make. And it's all technically money that you're keeping because as an employee, you are not allowed to expense things towards your income. What you make is what you get taxed on. Or when you're a self-employed creative, the money you make, you then have the opportunity to submit business expenses and say, here's the things that I spent money on this year that are qualified business expenses that drove new business and drove revenue. They were revenue driving expenses. Here's the things I spent money on this year. That's now reducing my taxable income, which means I get taxed less. We have that advantage, and people that are employees do not. Small business owners win in that category, which is awesome, okay? So that's point number one. You need to understand you do not get taxed on what you make, you get taxed on what you keep. And so this gives us the opportunity to consider, well, the second thing you got to understand about taxes is how are you keeping track of the things that are going to help you reduce what you keep, which are called business expenses. So if you're new to the world of running a business expense is anything that the IRS or the CRA, whatever country you live in, deems a qualifiable expense towards business activity, okay? So a great example of this would be a camera. A great example of this would be a computer. A great example of this would be your phone. All the software you use to edit photos and videos would be flights that you took to go to a shoot that you had to shoot. Meals with clients, right? Different parts of writing off mileage on your vehicle if you use it for work. There's so many things that are tax deductible. Actually, if you ever buy a course from Creative Rise, if you invest in the mastermind here with Creative Rise, you are investing in education. You're investing in business development. That is tax deductible. That reduces your profit, right? And reduces how much you're going to get taxed. So what's really important is that a lot of creatives, I've met creatives that, one, some of them don't even keep track of their expenses. Not at all. They throw out receipts as soon as they buy something. They have no idea what they're spending in different categories, gear, office expenses, meals, travel. They have no idea. They don't keep track of their expenses at all. And then at the end of the year, they go, well, I think I had a bunch of expenses, but now I'm getting this big tax bill because all they showed was their revenue, which the government thinks is pure profit because they didn't have any expenses to reduce that. And then I've also met creatives who are like, no, I keep track of my expenses, but they're keeping track of their expenses in like their iPhone notes app, and they're just scrolling through their notes. And they're like, oh yeah, here's a note that's called business expenses. And they just write down what it was or what store they bought it from or what the item was. And then they write down how much it was. That is not a good way to keep track of your expenses either. Okay. So you can get audited up to 7 years into the past. And so it's really important that you keep all your receipts. So what I actually do every single time we buy something, whether it's in person or whether it's via email, I get an email receipt, automatically I take this phone and right away I take a photo of it and I upload it into our QuickBooks, okay? Because that's what we do all of our bookkeeping with. I upload it into our QuickBooks. It automatically saves that receipt in that software. Now I have a photo of that receipt. If I ever got audited, I can show the original receipt with the transaction where we took care of it in our books. If I get a digital receipt via my email or text, I forward it to a specific email address that's set up with QuickBooks, and it forwards it right into that system. So we have a really good system for keeping track of our expenses. So I can go into my QuickBooks right now, and I at any point can look, what have we spent year to date on meals? What have we spent year to date on gear? What have we spent year to date on software, right? To run the business? What have we spent year to date on flights and travel for shoots? So it's really important you have a good way to actually keep track of your expenses, which are called write-offs, right? Because when you are able to keep track of those, you can write off those expenses off of your income, reduces your taxable income, aka your profit. Therefore, you only get taxed on what you keep, your profit, not what you make. That's a very, very important thing. So if you do not have a good system for that, I would highly recommend jumping on into something like QuickBooks. It's definitely worth the price, okay? There's some options that might be a little bit more expensive, might be a little bit cheaper. It's 100% worth the price, guys, to get a software like that. If you say, but Joey, I don't know how to use those softwares. They're always a little bit complex. I'm not a finance person. Go on Fiverr and hire someone off Fiverr to sit down with you for an hour. Who cares where in the world they are? Make sure they're a QuickBooks expert and have them teach you how to use the software. Have a friend teach it to you. Have your father, your mother, whoever, your grandma, whoever knows how to use the software. It's not an excuse that it's complicated, guys. Learn how to use it. It's going to really, really help you. Okay, here's the third thing that's really important about understanding taxes come tax season, okay? It's important you have the right type of entity. Business entities are important to consider. And the reason why is because different business entities can shelter your income in different ways. Gives you protection legally. It also gives you tax protection. So when I was in Canada, when I first started my business, I was a sole proprietor. Now, if you're in Canada, if you're in the US, if you were in Australia, I think the UK would be the same. They'd call it this. It's probably something along the lines of being called a sole proprietor. You register your business, and your business is simply run through your social insurance number, your social security number. It's run through you as a person. There's no entity that the business actually is. It's just you, the person, and you're using a business name, an acting business name, or you're using maybe your own name as the business. Now, that's a great way to get going. That's a great way to get started. I highly recommend that. You don't have to get too serious right off the bat, but as soon as you're making over like $30,000, $40,000, $50,000 a year, I would highly recommend jumping on in, if you're in the US, jumping on into an LLC, jumping on into an S Corp. If you are in Canada, I would highly encourage you to consider what it looks like to talk to an accountant about getting incorporated, getting a corporation. And the reason for this is twofold. Number one, it's going to give you actual personal liability protection. So if your business ever gets sued, someone comes after you for something for some reason, if there's ever a problem or a conflict, that's going to create some degree of separation between you personally and the business assets, which is a really good thing. Because if someone's trying to sue your business and your business is not separate from you, you're going to get sued personally. They might take everything you own personally, right? Where if they're suing the business, there's a little bit more protection there, okay? That's the first reason. Now, the tax reason is that when you are a business, you're an organization, you are a corporation, you're an LLC getting taxed as an S Corp here in the States, you are a corporation in Canada, what's happening is you actually get to take the money you make, the revenue, you actually have to pay yourself a salary that gets taxed normally. So you pay state tax, you pay federal tax, you pay social security tax, employment tax, right? And then the rest of the money that's left over, you can pay yourself in what we call distributions, which are taxed. the same way, state-wise, federal-wise, but they're not taxed from like a 15% perspective around like Social Security and employment taxes. And so what's really unique and really cool about that is, let's say that I'm going to give you some normal numbers here, okay? Let's say you make $100,000, okay? And let's say that you only need, immediately let's say you have $35,000 of expenses, which means you profited $65,000. Let's say you pay yourself a $30,000 salary. Now there is $35,000 left over in the business that comes to you in the form of distributions that you pay a lower amount of tax on than you did on that $30,000 of salary, okay? So we had $100,000 of income, we had $35,000 of expenses, which dropped our taxable income to $65,000. And then we had $30,000 of salary that got hit with Social Security tax, that got hit with the Medicare taxes, that got hit with state taxes, federal taxes, employment taxes, all the taxes, okay? Your salary is going to be the highest taxed form of receiving money you ever receive. So it's cool if you can make your salary as small as you can and then pay the rest to yourself in distributions. You're going to be able to keep more money that way and pay less tax, okay? So that right off the bat is only possible if you have an entity, if you have a corp, if you have an S corp. So it's really important that once you start making, a money, probably a threshold, again, like I said, it's probably like $40,000, $50,000. You should really start considering that. As soon as you're making more than you need to like really actively live on, or more than you need to actively run your business, meaning you have additional profit, you should really start to consider what it looks like to get the right entity to start helping you save some money on tax. So to make that really simple, if you were in the US, you should probably be an LLC, get an LLC, and then elect that LLC to be taxed as an S Corp. That is where you turn it into a corporation come tax time. You pay yourself a salary, you pay yourself distributions with the rest of the profit. You're going to save money there. If you're in Canada, make sure you get a corporation. Okay, once you're making $50, $60, $70, $100,000 a year, it's going to save you some money on taxes, and it's also going to give you a lot of liability protection, which is really great. So getting the right entity really matters, okay? Now, the fourth thing I want to talk about real quick is tax brackets. A lot of people get tax brackets wrong, and they ask themselves the question of this: what tax bracket am I going to be in this year? Am I in the 12% tax bracket? Am I in the 18% tax bracket, the 22, the 28% tax bracket? What am I going to be in this year? That is asking the wrong question, because that is assuming that all of your income gets taxed in one tax bracket. And for people that are new to the tax system, your income actually gets taxed on a gradual sliding scale. Meaning, let's say that you are quote unquote in the 22% tax bracket. You're not actually in the 22% tax bracket, because the first $10,000, $12,000, $11,000 of your income is actually getting taxed at like 4% or whatever. The next, $30,000 of your income is going to be getting taxed at like 12%. And then the remaining parts of your income above that additional $40,000 that you've made, the last, let's say you made like 60 grand. So let's say the last $15,000, that might be getting taxed at 22%, but all of your income is not getting taxed at whatever tax bracket you think your income is getting taxed at. Only the highest amount of money you've made, the remaining money in the highest percentage, is what's actually going to be getting taxed at that higher tax bracket. So here's why I say that. It sounds complicated, but here's why I say that. It's important to really understand and estimate what you think you're actually going to be getting taxed at each and every single year. And by figuring out your effective tax rate. Your effective tax rate is different than your tax bracket. Your tax bracket is at the highest peak of my income. What is the last dollars, the highest amount of dollars that I'm going to be making this year? Say you're making 100 grand. What is the last $30,000 of that 100 grand going to be taxed at? Yeah, it might be 24% or 32%, but the remaining, $80,000 prior to that or $70,000 prior to that is going to be getting taxed on a gradual sliding scale. And then when you mix all of those together and figure out what, on average, you're paying on that $100,000, that's where your effective tax rate goes and really comes from. So here's what I want you to do. If you're like, I want to understand that more, go into ChatGPT, say, hey, here's the state I live in, or here's the country and the province I live in. Here's the amount of money I'm estimating to make. Can you help me understand from a federal and from a state or federal and province perspective what you think I'm going to be paying on this money I'm making. I'm making X amount of dollars this year. Here's how much profit I think I'm going to have at the end of the year. Can you help me understand what my effective tax rate is going to be and show it to me? Break it down. That prompt is going to make what I just said really easy for you. It's really going to help. Okay. Last thing I'm going to say here about taxes. This is super, super important. Okay. You need to be managing your money properly in order to actually run through tax season well. This is one of the biggest mistakes that we see people make because they don't understand taxes. They don't understand how taxes work. They are not prepping for taxes. They're not saving for taxes. They are not paying quarterly taxes. And there's some issues with this. We all know the feeling, unfortunately, where you get to, March or April here in the US or in Canada, and your accountant slides on over. You should have an account, by the way, guys. That's just basic. If you own a business, you need to have an account. The second you have profit, you need to have an accountant. They're going to help you so much. It's worth the investment. They're going to help you grow your business. They're going to help you understand your books. It's worth the investment. You also should have a bookkeeper. If you're doing six figures a year, $100,000 plus, 100% you should have a bookkeeper paying like $150 to $200 a month to help manage all of your books, make it really easy, clean, hand it off to your accountant. By the way, we're going to move on, but that's really important, okay? I was talking about managing your money. Okay, so because a lot of people don't understand taxes, they don't understand what they are probably going to be taxed. And a lot of people get to March, April, and they get a tax bill slid over and say, hey, you owe $8,000, $22,000, $34,000. And it is a horrible feeling when you get a tax bill and you don't have the money. You've already spent the money. Who knows what you spent it on, but you already spent the money. That is a horrible, horrible feeling. And so here is what I would highly recommend you do each and every single year in order to make sure that you have money every time Uncle Sam comes knocking and says, you owe us some tax, pay up, okay? So the thing that Christy and I have done for years now, this has been like 7-8 years. I did it. I haven't known, Christy and I haven't been running the business together that long. But we've been married for 5 years and we started our businesses together in 2020. But we both had businesses since about 2014. And I started doing this on my own prior to meeting Christy, but it is having percentages in which you divvy up your money when you make money. Now, we've got other podcasts on this. You can go in more in depth on this and really understand how we do this. But I actually think I might have made a free training about this. If I did, check the show notes. I'll link it here. I'll take a note of that to make sure I add that into the description here. But I actually did a free training on this, I think. So I'm going to pull that up here. I'm just going to leave myself a note. Post free training in description. All right, here we go, guys. So I'm going to post that for you. You'll be able to find that there. But managing your money is super, super crucial to making sure you have money, one, for your financial future, two, to make sure you can pay your taxes every year. If you have a business and you have no money left over at the end of the year, even though you know you made more money and you should have money left over, but you misspent it, then what is the point of you running a business? You're trying to build a steady financial future for yourself, and of course, enjoy it in the process. The whole point of work, guys, is to enjoy work and to build yourself a financial future that you are excited about and you can look forward to. So it's really important that you manage your money well. The way that we encourage you to do that, and this is what I'm going to break down in the free training that's in the description, is when you get paid, I want you to think about every dollar as an employee, and I want you to start putting it into different accounts to make sure that you are putting aside money for the things that matter most. Well, what's the thing that matters the most? Number one is putting aside money for your financial future. So you can invest in your financial future, whether it's stocks, whether it's business coaching to grow your business, whether it's real estate, it's crypto, whatever it might be. Investing in your financial future is the first and most important thing you can ever do. The first second you get $1, your business earns $1, okay? Or you take profit home and you pay yourself out. The second thing you need to really make sure you do is you need to put aside money for taxes. Put aside money the government is going to come after you for, because it's not your money. It's the government's. They're going to come knocking for it, and it's very important that you have not misused it and misspent it and no longer have it, okay? So here's what this looks like for most people. Here's what I recommend. When you make $100, I'm going to start with really easy, simple math here. When you make $100, what I want you to do is I want you to come up with percentages and then send that percent of money to a separate account. So everybody who runs a business should not have one bank account. You should have multiple bank accounts. You should have a business checking account, and you should have like 3 or 4 business savings accounts that are all labeled different things. You've got future investments, you've got savings, like tax savings, you've got rainy day fund to make sure if your business ever fell on hard times, you've got a little bit of some operating expenses in there to keep your business afloat for a few months. You've got, maybe you even have a giving account. Christy and I have a giving account we funnel money into, then we get to give to things that we're really passionate about. And here's how it works. I'm not going to share with you our numbers. I can, but I'm going to share with you numbers that you should start with. Okay. So when you make $100 immediately, I would encourage you to take a minimum of $15 and put it into a future investments fund. Okay. So that is the bank account that you're going to title future investments, that you're going to stack money into to save for your own financial future and make investments out of that account for your financial future. Well, if you're putting 15% towards your financial future, that means that you have 85% left, $85 out of the $100 left. You should then take another $15, 15%, and put that into a tax account, okay? This is going to be money that you're stacking and saving for taxes. Now, this is very important. You need to figure out how much money you're making and figure out what your effective tax rate is going to be, because maybe you're going to get a total tax of like $30,000. Over 30%, which means you need to be saving like 30% of your income for taxes, not just 15. So this is why you got to figure out your numbers. I'm just giving you numbers that everyone can start off with. 15% to future investments, 15% to taxes. I would encourage you to do like 10% or around there to going to a giving fund if you can, that you can give out of. We believe your business is meant for good. If you can make that happen, that's awesome. Fun things you really are passionate about in the world. A 7.5% distribution should come. So $7.50 from that $100 you made should go to an account called Rainy Day Fund. And once that account has about 4 to 6 months worth of operating expenses for your business, meaning your business could run with zero income for 4 to 6 months and still be fine, because you can pull money out of that account to pay for things and make sure your business can still operate. Once you have 4 to 6 months of that, you don't have to keep funding it and you can leave that alone. But right there, you've got a couple different accounts. You get your main account. That's all where all the money comes in. So your $100 came in. You've now siphoned 15% to your future investments account, bank account. You've siphoned 15% to your tax bank account, your savings account. You've siphoned another 7.5% to a rainy day fund account to build up 4 to 6 months worth of operating expenses. And then you're funneling off, if you want, another like 10% to give to things that you're really passionate about. The remaining money that you've got left over in there. So what is that? That's 15, 7.5, and then we'll make the 10% optional. I won't include that. So that's 37.5%, which means you have 62.5% left. The 62.5%, so $62.50 out of the $100 you made. Math. Wow. That is going to be what you operate your business off, and that's going to be what you pay yourself out in order to live on. So this is where you got to figure out what percentages are going to work so that you can pay yourself out and make sure that your business is paying you personally so you can afford to live, but also making sure that you can sustain and run your business. And then those other accounts are savings account for taxes, savings account for your financial future, and then a savings account for if your business ever falls on hard times. That right there is how you save and distribute and manage your money properly throughout a calendar year, so that when March comes, you're not nervous when the tax bill comes. I'll tell you this, it still doesn't feel good. Still doesn't feel good to see that money build up all year and then leave your account because you had to pay it in a tax bill. But I'll tell you this, it feels a lot better than if you got that tax bill and you had no money in your account to actually pay your taxes. That sucks. You never, ever want to get in that position. So guys, that's a couple tax tips there for you, okay? So I'm going to go over them one more time. Make sure you understand that you do not get taxed on your revenue. You get taxed on your profit. That's a very, very important one. Make sure you understand write-offs. You understand business expenses so you can reduce your tax liability, aka how much profit you keep, which is what you end up getting taxed on. Make sure you understand what entity you should have in order to structure yourself best, to have the best performance, not only in business, the best protection, but also the best liability towards taxes. Make sure that you understand tax brackets. You understand what is an effective tax bracket versus a standardized tax bracket. You understand where you're going to fall in that. You really track that. Make sure you have a bookkeeping system to keep track of your business expenses. Highly, highly encourage you to get an accountant and get a bookkeeper. And last but not least, make sure that you are understanding how to manage your money in a simple way. Again, if you want that free training, I've linked it in the description of this podcast. Once this podcast goes live, I'll make sure we've attached that in there. I'm just going to be breaking down the money management system that I just taught you, but in a little bit more detail and with some visuals. So hopefully that's really helpful for you. But guys, this is fun. This is good stuff to talk about. If you are totally new to this tax conversation, I'm glad you're here. If you are not new to it and you feel like a pro, I'm also glad you're here. If you're someone who feels like you've been burned before by not doing some of the things that we mentioned in this episode, and you know you're going to make some shifts so that next year is different, I commend you. Good job. I'm proud of you. But guys, this is fun stuff, and this is definitely going to help you grow the business. Here at Creative Rise, we believe in helping you understand business so you can get paid to do what you love. But we also want to help you make sure you know what to do once you get paid so that the government doesn't swoop on in and take all your money, or you just don't mismanage and misuse your money and end up with nothing at the end of the year, because that is also not good. So for me, Christy, and the rest of the team that makes this happen, we're proud of you guys. Thanks for being here. Make sure you share this episode. If this episode was helpful, shoot us a DM on Instagram. We really appreciate when you guys come and connect with us on Instagram. Shoot us a DM and just say, hey, bro, helpful. I love that tax episode. Maybe share it with a friend. Maybe take a screenshot of it, post it on your story. If you do, tag us so that we can see that. We can thank you for sharing the show. It's a great way that the show can get out and spread to more creatives, that we can help get paid to do what they love and sustain that as a self-employed creative, guys. Literally, I've got the water bottle right here. Self-Employed Creator Club. We're all about it. So anyways, guys, hope you're having a great day. We'll catch you guys next week.